Welcome to After Hours Action. I'm Greg Greenberg from TheStreet. The major averages squeezed out a win today, finishing in the green after a week chock full of earnings reports that were generally pretty good. We'll talk about those in a second, but first, let's wrap up the market. Stocks capped off a pretty successful week on an up note Friday after earnings results from Amazon and shipping leader UPS bolstered the outlook for the U.S. economic recovery. Treasuries also strengthened after a drop in consumer confidence eased speculation that the Fed will start tapering its bond buying sooner than expected. In other words, easy money and solid earnings are moving everything up together. The S&P 500 was up 8 points to 1760. The Dow added 61, and the Nasdaq closed 14 points higher at 3943. Let's talk about commodities. Gold finished $2 higher at $13.52, and oil finished almost $1 higher at $98. So like I said, everything went up together today. Shares of UPS, the world's largest package delivery company, finished up 1%. That was one of our top stories today. UPS is widely seen as an economic bellwether. They said net income more than doubled due to more U.S. shipments at higher rates. The shipper earned $1.16 a share for the third quarter, a penny better than expectations. Meanwhile, Procter & Gamble fell by 1% to $80 a share. P&G met Wall Street expectations due to growth overseas, cost-cutting, and a lower tax rate. Company earned $1.04 a share in the first quarter. Sales rose 2.2% to $21.21 billion, beating top-line expectations. However, disappointing performance in some of its businesses kept a lid on the stock. The real action today was in tech, with Amazon and Microsoft popping Friday after they trumped earnings expectations late Thursday. Amazon finished 9% higher to $363. The world's largest online retailer posted a quarterly loss of 9 cents a share, meeting street views on revenue of $17.1 billion, which topped estimates. Meanwhile, Microsoft rose 6% on Friday. Mr. Softy beat street estimates by 8 cents on the bottom line, also beat on the top. Finally, a little more tech news. Twitter excited the street today. The company's roadshow hit New York today as it moves towards its November IPO. It said in a filing late yesterday that shares will be priced between $17 and $20 a share. Twitter said in October it will list its shares on the New York Stock Exchange. Seeking to avoid a repeat of Facebook's much maligned public debut, Twitter revealed more modest ambitions. The money-losing social media company said it plans to raise up to $1.6 billion in the offering, giving it a value of $11 billion. The valuation was a tad more conservative than the $15 billion some analysts had expected. Aside from Twitter, the other big topic of conversation continues to be Obamacare and the uncertainty surrounding it. And while everybody knows the market supposedly hates uncertainty, healthcare stocks continue to be one of the best sectors in the market. The healthcare spider ETF, the XLV, is up 32% versus 24% for the overall S&P 500. And despite worse than expected consumer data out today and stubbornly high unemployment, consumer discretionary stocks are up 33% for the year. So what gives? Here to talk about the best and worst sectors of the market is Alex Gervich of the Rockledge Group. Welcome, Alex.
Hello, Greg. Good to see you.
All right, it's good to see you too. So tell me what's going on with healthcare. It really has continued to outpace the S&P. It's a sector that you like, you've made money on. Will it continue to do as well going forward?
I believe so. We've been long healthcare for almost a year, just a bit less, and it's, as you already noted, it's been doing quite well. One of the reasons is simply speaking because the sector and the spending in the sector are growing. So since I base my analysis fundamental valuation, so clearly it will drop down to the bottom line, to the net income, and we will see higher profitability. It makes sense. Despite all the uncertainty, as you mentioned, with Obamacare uncertainty, whether like it or not, it's here. ACA, it's here to stay. And there will be some changes to it, there'll be some modification most likely, but the spending is going to go higher and the company will be have more revenue and thus profit going forward.
All right, let's talk about the consumer discretionary ETF, that's the XLY. Once again, having a great year. It's had a great year for the past 5 years. It's one of the leaders over the past 5-year performance, 3-year performance, 1-year performance. 5 years takes us back to the financial crisis. You had a lot of pent-up demand over that period. So if Americans purchased everything they need at this juncture?
They're getting there. I believe I'm also long discretionary sector.
You're sticking with it?
I'm sticking with it. Not as long of a term, at least for now, as healthcare, but as of now, it's certainly sticking with it. I think one of the reasons is that despite, no matter how sluggish the economy and the unemployment rate, it is getting just a better. Tad better, as I say, is that although it's not the best, part-time is still better than no job. And so people are moving to part-time jobs, and the employment overall, I think, is going to improve slowly but steadily. And by default, we spend
We do, as Americans, we do.
We do.
Now, technology shares have not really done as well as consumer discretionary and healthcare. Today, we had some great results from Microsoft. That stock popped. Amazon, as I said, popped. However, when you look at the, I guess what's the XLK is the spider, and you own spiders in your portfolio. You don't own individual stocks. Has not performed as well as healthcare and materials and industrials. Why is that?
Well, I'm out of technology sector, and I've been out for quite a long time. My belief is, again, it's fundamentals, because that's where my analysis comes from. Despite the fact that Amazon did well, although Amazon not necessarily a technology company, I think it's more of a consumer company, discretionary company. But other technology firms did have better earnings. I don't think it's a sustainable, because bottom line, there's not a lot of spending on the IT industry overall. We will probably have a pop with the new iPad and things like that with the consumer spending towards the end of the year, holiday season. I just don't believe there's enough bottom revenue. I don't believe there's enough fundamental revenue growth and upside going forward for a long time to have any meaningful technology pop.
All right, I think we're going to hear more from Apple next week. We'll hear what they have to say next week. Everyone's going to have to watch that. Thank you, Alex Gurbich, and thank you for watching After Hours Action on the Street. I'm Greg Greenberg. Please come back Monday.